Welcome to the Plan Stronger TV market update for Wednesday, March 18th. Let's dive right in. Take a quick look at those numbers in the rearview mirror for 2025 total returns on these indices that we follow and share with you. You can see strong across the board results. Now let's slide those over and we'll look at where we are year to date for 2026. And if you just woke up, took a long nap year to date, you'll see that the Dow's off a bit, S&P 500, those first three indices off modestly, and then the small caps off, or NASDAQ off a little more, and then small cap and foreign stocks in positive territory. And I'm making the point about taking a nap and waking up on March 18th because we've seen the recent volatility in the market pulling back a little bit. So, but if we're looking at it over a little bit of a longer period, not as big of a deal. So let's dive into a conversation with Robert. Robert, so I've kind of set it up there with investors. They can get frustrated, they can get anxious, they can become nervous, they can go to cash, and it seems like often enough those decisions are not the right ones. And then later like, oh, I shouldn't have done this or I shouldn't have done that. So once we get through, which I believe and I know you believe we will, the current environment and all of what's going on with Iran, where do you see things going from there? Do you think that we'll see a resolution and the market kind of get back to where it was before all this happened?
Yeah, there's a whole universe of finance called behavioral finance out there, and when things are not going so well, and there's a lot of factors that are contributing to volatility, such as the current war with Iran and an election year, and things we're experiencing now. A lot of it, we always say, don't run all into cash and get out of the market. But then, like you had asked, David, there's the flip side to the same coin. When things do get better and money starts moving back into the market, and there is a lot of money on the sidelines right now, but when things do get better and money starts moving, individual investors start experiencing something called FOMO, or fear of missing out. So, David, just like you said, we have ebbs and flows. Right now, we're kind of in a negative flow. Like we got some PPI inflation numbers hotter than was expected 0.3% increase in the PPI, came in at 0.7, which is year over year up 3.4%. So, the markets futures are trending down right now. But, things will happen when, we always think, what's a bad thing that can happen? Like oil is completely cut off. Well, what happens when let's say the conflict is resolved, there is regime change, or the Strait of Hormuz is open, regardless of whether there's a regime change or not? People are going to get excited, and investors are going to start pouring into, when we say the market, there's also the bond market, but we're talking about flowing into the risk assets like equities. Equities are going to shoot up. And what we don't want individuals to do is to say, I am so afraid of missing out on this. I'm going to forget my plan, go heavier, go more risk. My risk tolerance is suddenly a lot higher, and I'm going to move so much money into risk assets. That's just as bad of a move as if you want to take all your cash out.
Yeah, well put. So one of the things I want to underline of what you shared, Robert, is talking about inflation, the barometer of the PPI, the Producer Price Index. So let's get some perspective. Yes, it's a little higher than was expected, but that doesn't mean it's quadrupled, that all of a sudden we've got a 10% inflation rate. And I think we've got to keep it in context. The market will react, and investors, likewise, to the data and what's coming out. And so, the implication of a little hotter inflation rate reduces the probability that the Federal Reserve is going to cut interest rates. They'll keep them a little higher. And a lot of market movements and how the market responds has to do with expectations on interest rates.
Exactly. And also, don't forget, let's look at the long-term trend. All of 2024, PPI was 3.5%. All of 2025, it moved down to 3%. That's a 0.5% move lower. So what will it be in 1 year from now? What will it be for 2026? Will it go dip below 3%? Might it be a little higher than 3.0, maybe 3.1, 3.2? Only time will tell. But this is a month over month looking
Right.
back at the last year. So
Yeah, and it changes quickly, and so it's kind of hovering around, that 3% plus or minus range. And my key point is this: it's not an impediment to the market. It's not an impediment to the economy. It's not rampant inflation, even if sometimes the media kind of exaggerates what's going on. All right, so any particular sectors or asset classes you're seeing, Robert, that in particular are moving in this environment we're in, where we're kind of seeing, the tightening on Iran, the military action. Obviously, somebody raises their hand and wants to, fight with the United States and Israel, then there is a change. There's clearly a movement afoot to see regime change, and there's a positioning so that the Iranian people can make that choice, which makes sense. So anything in particular that we should be looking at in terms of sectors or asset classes?
yeah, so let's go back since to the beginning of the year, and really since November. We've seen large cap growth stocks. Magnificent Seven being the most prominent since November, and especially beginning of the year. Outflows of money. So in January, the overall U.S. large cap space, or U.S. equities, saw outflows of $34 billion. Now, that was mostly in large caps, and especially U.S. large cap growth, because small caps and mid caps actually saw inflows. But overall, U.S. equities saw outflows of $34 billion in the month of January, and that's, we don't often see that. Usually U.S. equities, people are flowing into them. February, just in large cap growth, outflows of $18 billion. Not a whole lot when you have, a few companies and, valued at 2 to 3 trillion. But
Right.
again, the movement out. That's where the money's moving out of slightly. Where's it moving into? International, non-U.S. developed, emerging markets, and also to fixed income. So again, with all the money that's on the sidelines in cash, the money that's moved to fixed income, when things do turn around, which they will, sentiment will become positive. And when that will happen, we're not saying, but it will happen eventually. Then you start, several investors go in, the smart money moves in, and then retail investors start piling in, and you have everybody else, oh my gosh, I'm missing out, and they want to go all in as well.
Yeah, and you've already spoken to this, Robert. How do investors usually respond to these market movements, and how can they be better positioned, or have a better response if that is something that is lacking?
Yeah, so we've already said, how do they usually respond? Either, times bad, all cash. Times are great, go all risk on. Both of them are wrong answers. If people have a plan, but they want to change it because, hey, you know what? People, even though they were at all-time highs, retail investors and a lot of the smart money started moving out of U.S. large cap growth, the NVIDIAs, the Microsofts, the Apples, et cetera. They said, you know what? They're at nosebleed levels. Valuations are like, I'm going to trim off and take some money out and move towards here. That's kind of the smart way to do it, at the margins. That's the key word, margins. So when you have a high rolling or asset sector that you're allocated to that has done phenomenally well, it's always a good time to kind of rebalance. So if it's, you wanted 10% in international and you're up to 12, 13% because they've done so well, time to trim that back down to 10% and take that 2, 3% and move that into sectors that haven't done so well, maybe undervalued, and have more of a probability to come up. That's called rebalancing a portfolio and perhaps making some adjustments on the margins. That's a way to manage a portfolio, and how your advisor or whoever's handling your money really has to be looking at your portfolio as a whole.
That's how it's done. That's good. And the fancy word that we're going to get to, talk about an individual stock like a NVIDIA or something, it jumps up quite a bit. And then part of the reason why professional money managers want to look at that and maybe bring it back down is because of what's called regression to the mean. And that is basically, individual stocks don't go up forever. And there are stories after stories after stories about that playing out in the market. And so we just want to be careful about how much money we have in any one thing. It doesn't mean, though, that if you are still a long way away from retirement, you shouldn't keep your money invested in the market. It doesn't mean that if you're in retirement and you've got 30% of your money invested in the market and the rest is in safer things, that you should change your whole plan and say, hey, it's a new day, it's a new world, I need to redo everything. Probably not, but it's always good to reevaluate and just confirm that you're on the right track. Okay? Final thoughts.
He hit it on the head. We'll end there.
All right. Well, we try to hit it on the head and get it right, but we never think we get it perfect, and we always want to come back to you with more good information that you can use to plan stronger.